Hi there, this is Hugo. A foundational agricultural staple just saw a 90% drop in quarterly profits, and the market is pricing it like a dying business. Let me show you why they are completely misreading the real story underneath the hood. At its heart, Cal-Maine Foods produces, packages, and distributes shell eggs and prepared foods. They sell affordable, staple protein to national grocery store chains, club stores, and food service distributors across the United States. What makes this business incredibly interesting right now is a massive disconnect. Mr. Market is terrified of a temporary downward cycle in commodity egg prices, completely ignoring that management is actively fortifying the business. They are structurally shifting away from pure commodity reliance toward a much more predictable and resilient model, and the market is giving us all of that future growth essentially for free. Let's look at how they actually make money. Their revenue streams are broken down into specialty shell eggs, which are your cage-free, organic, and pasture-raised options, conventional shell eggs, prepared foods like hard-cooked eggs and protein pancakes, and a small sliver from feed and agricultural byproducts. The competitive angle here is textbook vertical integration. Instead of just taking whatever the spot market gives them, they are acquiring feed mills to control their own input costs. Better yet, they are shifting their pricing structures toward grain-based and cost-plus arrangements. This effectively smooths out the wild commodity swings and creates a much more stable floor for earnings. This gives us a consumer defensive business with a market cap of about $3.65 billion and 48.49 million shares outstanding. Before we get too excited, we have to look at what could go wrong. We have to address commodity price volatility, biosecurity risks like bird flu, execution risk as they expand their prepared foods division, regulatory and animal welfare pressures, feed cost inflation, and the threat of a secular decline in demand from alternative proteins. The market is currently hyper-focused on the short-term pain. In the third quarter of 2026, the company suffered a brutal 90% drop in net income, driven almost entirely by a 56.5% drop in conventional shell egg selling prices. Panic sellers looked at this violent cyclical swing and rushed for the exits. But here is what the panic sellers are missing. Let's start with the real constraint. The regulatory shift to cage-free farming is a material cost that requires ongoing capital. However, Cal-Maine is well ahead of the curve. Specialty eggs and prepared foods now make up 52.9% of their net sales, massively reducing their exposure to those conventional commodity price swings. As for the bird flu headlines, historically, national supply shocks actually cause wholesale prices to skyrocket, expanding Cal-Maine's margins due to their superior biosecurity. They've also mitigated feed inflation by buying their own mills, and fears of a secular decline are contradicted by retail egg volumes actually being up 3% this year. Let's see what this business actually puts in our pocket. We begin with the cash this business actually generated over the trailing 12 months, which is $892.43 million in operating cash flow. We subtract stock-based compensation, and I absolutely love seeing $0 here. Management isn't diluting us with funny money. We subtract a working capital change of $20.22 million to account for real operational cash needs. Next, we subtract $164.89 million for maintenance capital expenditures using a normalized 5-year historical average to reflect true reinvestment needs. We have $0 for working capital reinvestment. After all the real costs, this business generated $707.32 million in true owner earnings. When we divide that by the 48.49 million shares outstanding, we arrive at an owner earnings figure of $14.59 per share. To see if this farm is built to last, we look at capital efficiency. They are generating a return on invested capital of 27.35%, easily clearing their cost of capital of 6.15%. Their competitive position is firmly rooted in absolute low-cost positioning and unrivaled scale. This shows up in a trailing 12-month gross margin of 33.77%. What's even more impressive is their product mix, with specialty and prepared foods now driving 52.90% of their net sales. Management's successful shift away from pure commodity reliance means their competitive trajectory is actively strengthening. The compounding engine is firing on all cylinders. Despite the commodity cycle noise, they've grown revenues over 5 years at 25.82% annually, while their owner earnings have compounded at a staggering 110.94% over the same period. But the ultimate protection here is the balance sheet. They are holding about $1.15 billion in pure net cash, with absolutely zero total debt. That means $23.76 per share is sitting in the vault. And management isn't just hoarding that cash. They act like highly disciplined owners, returning excess capital to partners by paying out $330.29 million in dividends annually and repurchasing $151 million of stock over the trailing 12 months. Running this through our investment checklist, do we understand the business? Yes, it is the largest producer of shell eggs in the country, selling an affordable, non-discretionary staple. Are the economics durable? No, not perfectly. While the returns on capital are excellent, the constant threat of biological risks and ongoing regulatory capital requirements mean we have to build in a significant margin of safety. Is management honest and able? Yes, they take zero stock-based compensation and are executing a brilliant vertical integration strategy without using debt. Finally, is the price attractive? Yes, the market is mispricing this heavily based on one cyclical quarter. Let's look at the actual math. We start with our owner earnings of $14.59 per share. Because of the regulatory and biological realities of agriculture, we refuse to assign a premium multiple here, using a very conservative 7 times multiple instead. We multiply those together, then add the $23.76 in net cash per share to arrive at an intrinsic value of $125.89 per share. With the stock currently trading at $74.99, we are looking at a margin of safety of 40.4%. My verdict is a clear value opportunity. The market is mistaking a temporary cyclical trough in commodity egg prices for a structural decline, completely ignoring that management has successfully shifted 52.9% of their sales to higher margin specialty products. You are getting a business that generates phenomenal returns on capital, run by managers who act like owners, backed by a massive cash fortress, all at a steep discount. Thank you so much for walking through this business with me. Remember, this is just my analysis. Always do your own research before putting your hard-earned capital at risk. If you enjoy looking at businesses like this, consider subscribing for more deep value analysis. Stay rational out there, and I will see you in the next one.